Welcome to FutureVest. Today we're breaking down a fundamental question: how does the stock market work? Whether you're curious about the recent performance of big names like Tesla and Apple, or the buzz around AI stocks, understanding the mechanics of the stock market will give you a better grasp of where your money goes and why prices change every second. So, let's dive in. The stock market is a place where shares of publicly traded companies are bought and sold. It's essentially a marketplace, like a farmer's market, but instead of vegetables, investors trade ownership in companies. Shares, or stocks, are like small pieces of a company. When you buy a stock, you're purchasing a portion of that company. For example, if you buy one share of Apple, you own a tiny piece of Apple Inc., giving you a stake in the company's success. Stock prices are determined by supply and demand, how many people want to buy a stock versus how many want to sell it. If a lot of people are trying to buy shares of a company, the price goes up. If many are trying to sell, the price drops. Take Tesla as an example in 2024. With the rise of interest in electric vehicles, many investors see Tesla as a good buy, which often drives up its stock price. But if Tesla announces a setback in production, we might see a lot of people selling, which pushes the price down. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ. These exchanges connect buyers and sellers in real time. Think of them like virtual auction houses, only they operate 24/7. In 2024, stocks in tech companies like Nvidia, which has been booming due to the demand for AI chips, are actively traded on these exchanges. High activity in popular stocks often causes rapid price movements, which is why you might see Nvidia's stock price fluctuate significantly within a single trading day. Stock prices are also influenced by news and global events. In 2024, for example, AI developments and US interest rate changes have been major factors driving market movements. When the Federal Reserve announced interest rate hikes, the stock market reacted, as higher rates often mean lower borrowing, which can slow economic growth. Companies dependent on high growth, like many tech companies, saw dips in their stock prices. However, when AI firms announce breakthroughs, we often see a rally in their stock prices as investors anticipate growth in that sector. And that's the basics of how the stock market works. Remember, stock prices are constantly influenced by demand, company performance, and global events. So the next time you see a stock price moving up or down, you'll have a better understanding of what might be happening behind the scenes. If you found this video helpful, give us a thumbs up, subscribe to FutureVest, and stay tuned for more insights into the stock market.